I'm Deborah Borchard, and this is your midday market update. Well, the markets are down across the board. We started out the morning with news out of China on their GDP, not as good as one would have hoped. And then we got some more economic data that was a little disappointing. I'm here with Ben Willis from Albert Fried. So, Ben, you know, we got home builder sentiment that was disappointing, Empire manufacturing report disappointing. So just all brought in more sellers.
And yet here we are off our lows. The buy the dip mentality is in place. If you take a look at the trend right now, the internals of the market are telling you there are bids in this market. It's very frustrating for those of us that are looking for a correction in the market, because as we come down about 1% or so, there seems to be some sort of buy program, call it what you want, or buyers come into the market that refuse to let this market to correct the way I think it should. But we're still down, and we'll see what happens as Europe closes in a few minutes to see if the safety net of the U.S. equity market stays in place for them.
Well, I was going to say, you know, when you talked about that you'd wanted the correction we're getting is in the gold market, so it feels like that people have nowhere to go but stocks.
But the fact of the matter is the commodity markets were one of the leaders off the lows if you go back about 4 years, with the idea that the China will be the main driver to allow the rest of the world to export their market. It's a very luxury problem to have if you can sell off on a 7.7% growth in your GDP, because we were looking for 7.9. I mean, it leaves you wondering just how much the momentum is priced into the marketplace. But that we've seen flows out of commodity funds for longer, for over a month's period of time, rather than just what's going on today in China. So I think we're seeing a combination of effects that are having an impact on gold, but also the broad commodities market. Outflows of commodity funds as being called for by some of the biggest brokerage firms in the world. Today's impact on gold also having an coming from the central banks and the idea that deflation is well in place. So if gold is an inflation hedge, you don't need to have it right now in your portfolio.
All right, we are obviously still in the thick of earnings season. You know, we got Citigroup's earnings out. They were pretty good. So it does seem like, you know, maybe the earnings, even though the bar has been lowered, are coming out okay.
I can get over that bar. But Citibank certainly helped put a bid in on the market. The futures before we opened rallied about 3 handles on the CPI, on the numbers coming out of Citibank. So I think that was an important, again, the idea of the safe haven of at least the U.S. markets for the rest of the world's investors seeking safe haven from what's otherwise. When you look at China's market, stock market, it's been a pretty frightening move to the downside. So I think we're benefiting from that fear.
All right, well, there you have it. We were down, but not down as much, trimming some of those losses. And that's Ben Willis from Albert Fried, and I'm Deborah Borchard with The Street.